All right, let's get right into it. Today, we're taking a deep dive into Form 1042-S. This is one of the most important IRS documents out there for international finance. And we're not just going to skim the surface, we're going to look at the underlying mechanics and what they actually mean in practice. So maybe you've gotten one of these in the mail and you're thinking, what on earth is this? Well, if you're holding this form, you're holding a key piece of a massive global tax system. The real question isn't just, what is it, but what does it do and what am I supposed to do with it? We're here to break that all down. So here's how we're going to tackle this. First, we'll cover what the form actually is. Then we'll talk about who's involved. We'll get into the two main sets of rules, chapters 3 and 4. After that, we'll decode the boxes on the form itself, look at what happens when things get complicated with intermediaries, and finally wrap up with why this whole thing is so important for you. Okay, first things first. What is the fundamental job of this document? Let's get right to the core principle. You know, you might think of this as just a receipt, but it's way more than that. It's an official record of a taxable event. See, anytime someone pays U.S. source income to a foreign person, that payer often has to act like a tax collector for the IRS. This form, it's the paper trail that proves they did it. And for you, the recipient, it creates a tax credit you have to account for on a U.S. tax return. To really get how this all works, we've got to be super clear about who the players are and, more importantly, what their legal responsibilities are. And this term, withholding agent, it's a big deal. It's not a passive role at all. This is the person or company that is legally on the hook for calculating the tax, taking it out, and sending it to the IRS. They are literally the gatekeepers of the system, and if they mess up, the penalties can be pretty severe. And you can see just how the system is designed here. The definition is super broad, and that's on purpose. It's meant to cast the widest net possible. Basically, the rule is, the responsibility follows the money. It doesn't matter if you're a single person running a business or a giant multinational bank. If you control the payment, you are the withholding agent. Now, let's talk about the rules of the game. There are two parallel frameworks that make all of this happen. They work together, but they were created for very different reasons. Okay, this is the key difference you need to understand. Chapter 3 is the classic setup. It's about collecting tax on U.S. income going abroad. But Chapter 4, which came from the FATCA law, is a totally different beast. It's really an information gathering tool. It uses that scary 30% tax not just to get money, but to force foreign banks to report on their U.S. clients. So one's about tax, the other is about transparency. And you've got to remember this number, 30%. It's not just some random figure. It's the system's default setting. It's what happens when there's no information. If the person paying you doesn't have a valid form, like a W-8, that proves you qualify for a lower rate through a tax treaty, they have to withhold at this 30% rate. It's the law. All right, let's get down to brass tacks and look at the form itself. Every single box on here tells a part of the story and is a link in the compliance chain. Okay, box 1. This is how everything gets sorted. And here's something you might not realize. The agent has to file a whole new, separate 1042-S for each type of income they pay you. Why? Well, it's all about data integrity. It stops different kinds of income, which might have different tax treaty rates, from getting mixed up. It keeps the data clean for the IRS. Next up, box 2. This is the big number, your starting point. It's the total amount of money you were paid before a single penny was taken out for taxes. This is the number you need to be able to match up with your own records. And then there's box 7A. This one is absolutely critical. This is the actual cash amount that's already been paid to the IRS for you. It's like a tax prepayment. When you go to file your U.S. tax return, this is the amount you get to claim as a credit. It's where everything gets reconciled. So how does the IRS know why you didn't get hit with that full 30% tax? That's where these boxes come in. Think of them as reason codes. If the tax rate is less than 30%, these codes explain why. Maybe it's code 04 because of a tax treaty. If these codes are wrong or missing while the tax is reduced, that's a huge red flag for an audit.
Okay, things get really interesting when the money doesn't just go from point A to point B. What happens when it flows through other people or companies in the middle? This is where the system really gets stress tested.
And this directive from the IRS is a key piece of the puzzle. It shows you that the whole point isn't always just about collecting tax, it's about collecting data. You have to file a 1042-S even if the tax withheld was zero. This makes sure there's a complete data trail for all U.S. money going to foreign persons, no matter what. So, what happens when the information chain breaks down? When someone in the middle doesn't pass along who gets what? Well, the system has a protocol for that. If the agent doesn't know who to assign the money to, they have to take that unallocated income and spread it out proportionally among all the people they do know about in that payment pool. It's a clever way to make sure the money doesn't just vanish into a black hole. And this right here, this is the system's final safety net. What if nobody knows who the money is really for? If there's no documentation, the payment doesn't just get a free pass. Nope. The agent has to withhold at the maximum 30% rate and report it as paid to an unknown recipient. It guarantees that a lack of paperwork leads to the highest tax, not zero tax. Okay, we've gone deep into the mechanics. So, what does this all actually mean for you? Practically speaking, understanding this system is one thing. Knowing what to do is the next step. So, here's your checklist. Think of this as your game plan. First, check all your personal info. Make sure it's right. Then, match the income in box 2 to what you know you were paid. Double-check the tax withheld in box 7A. You're going to use this form to file your U.S. tax return. It's your key to claiming a refund if they took too much, or figuring out if you owe more. And whatever you do, keep this form safe for at least 3 years. It's a critical record. So when you zoom out, you realize this form is so much more than just a piece of paper. It's a node in a giant global network. Because of agreements like FATCA, the information on this form that goes to the IRS, it often gets automatically shared with the tax authorities in your own country. So this isn't some private document. It's an entry in a worldwide financial ledger, which really makes you wonder, as this global data grid gets tighter and more connected, who else is following the money?